Specifically, is the difference in this probability between a good economic future and a bad one much, much larger when you look at really high, maybe even unprecedentedly high stock
Yeah.
prices.
So if extremely high prices are way more likely in a good future than a bad one, and that gap gets even bigger for the absolute highest flyers.
Then focusing on those top performers, that maximal selection, should give you the clearest signal about which future we're heading towards. That specific mathematical property is called log-supermodularity.
Log-Supermodularity. Got it. So if that condition holds, maximal selection is good. If not, maybe not so good.
Precisely. It provides a theoretical basis for deciding when focusing on the best signals is actually optimal for someone trying to predict the future, like an economist using stock data.
Okay, so that's the theory. What happened when they actually tested this against real U.S. stock market data?
This is where it gets really interesting. They used a massive data set, CRSP stock data from 1976 right up to 2023.
Wow, decades of data.
Yeah. And they defined good and bad future economic states using a common benchmark, the Chicago Fed National Activity Index, or CFNAI.
And the results. Did the theory hold up? Was maximal selection the winner?
Well, here's the twist. On average, across that whole period, the data didn't strongly reject the idea that maximal selection is beneficial. It wasn't a slam dunk either way based on the average.
Huh. So not quite the result I was expecting.
But wait for it. When they started looking at specific time periods, a really critical pattern emerged. They found that these indices, the ones built by focusing on the biggest or best performing stocks, performed suboptimally as leading indicators, specifically when the future economic conditions turned out to be bad.